My name is Jake, welcome to the channel. In today's video, I'm going to show you how to make an 11.5% dividend yield with PepsiCo. Yield. Yield is what brings us here today. Everyone wants high yield on YouTube. No one cares about dividend growth nowadays. So I'm going to give the people what they want, yield and memes. Have you ever seen a commercial of some Giga Chad trying to sell you a course for like $7,767? There's got to be lots of sevens in there. That's how you know it's a scam. First off, never buy one of those. And second, they're almost always talking about option selling, derivatives, or some kind of Forex, FX, foreign exchange trading method. So in today's video, I'm going to show you what you would learn in some investing course, but without all the scamming part, and I'm going to do it for free. So why am I going to teach you this for free? Well, I guess I'm not. You watching this video generates ad revenue for me so I can pay my bills. And if I'm lucky, you might get so inspired by today's video that you may even click on some of the links in the description of this video. So the few bucks that I do end up making, in revenue from this video isn't quite Giga Chad returns, but I guess I can buy some milk and bread with it. I'm going to show you how you can turn a 3.8% dividend yield with Pepsi stock into an 11.5% dividend yield. And no, Sharon, it's not some kind of hocus pocus. It's actually legit and not very difficult to learn. But if it wasn't legit and if it wasn't real, well, it could look a little like this.
Here in my garage, just bought this new Lamborghini here.
I'm not an expert, and I don't need to be. With FTX, I have everything I need to buy, sell, and trade crypto safely.
Can you at least teach me how to shoot free throws?
A lot of people think this is how you mine Bitcoin, but you don't need a flamethrower to buy, sell, or trade Bitcoin and crypto safely. You just need FTX. I'm reloaded.
Well, my name's Bernie Madoff, yes, you've seen me on TV. I pulled off the biggest Ponzi scheme in history. While the SEC was napping, I stole 50 billion clams, ripped off people in America and every foreign land, scammed actors, bankers, writers, lawyers, universities, synagogues and churches, pension funds and charities, talk show hosts, baseball stars, Miss America too. Better check your 401k, cause I might have ripped off you.
Oh man, the people thought we would forget. Thank goodness the internet exists and all those old videos still exist. So what we're talking about in today's video is writing a cover call on PepsiCo stock. And the example that I'm going to use in this video is all real numbers from Friday's share price. So if you were to go and look at this here on Monday, assuming the market doesn't go crazy on Monday morning, this is something that you could potentially look at doing. I'm not saying that everybody should do this. I just want to share a real life example of how you can actually do this. And all of the numbers that I'm sharing in this video are real as of Friday's close in the market. So now I want to be very clear from the get-go of this video. The goal of this approach is not to generate the highest potential total return. So I don't have a crystal ball. I don't know what the market's going to do. So we're not looking at total returns when it comes to the capital appreciation with this approach. This is purely just looking to generate that juicy 11.5% dividend yield with minimal risk. So I don't want to see any comments of people saying, bro, just buy the S&P 500. This is for income. This is to generate income. So it's important that we're all on the same page here. So to understand this, you first have to understand what a cover call is. And so let's dumb it down for all the people in the back. So Randy owns 100 shares of Pepsi stock at $146 a piece. Randy would be willing to sell his Pepsi stock at $150 1 year into the future in September of 2026. Now, Shelly comes along and says, well, I would be willing to buy 100 shares of Pepsi stock at $150 in September of 2026. So Shelly agrees to pay Randy $1,135 up front. This is called the premium for the right to buy Randy's shares, his 100 shares, at $150 a piece in September 2026, 12 months out. So Shelly does this because she thinks that Pepsi stock will be worth a lot more than $150 by September 2026. And Randy agrees to this because he gets that $1,135 up front. And all of these numbers are as of today. So this is a real example. Both Randy and Shelly are happy because they both get something out of this agreement. So with this example, there's two possible outcomes. The first outcome is in September 2026, in 12 months, PepsiCo stock is under $150 a share. If this is the case, Randy keeps his 100 shares of stock and the $1,135 from Shelly. The second possible outcome is in September 2026, PepsiCo stock is trading over $150 a share. In this case, Randy sells his 100 shares for $150 each to Shelly, but Randy also keeps the $1,135 from Shelly. So let's break this down, how Randy generated an 11.5% income return from this agreement regardless of the two outcomes. So Randy generated $1,135 in premiums from his 100 shares valued at $14,600 or $146 per share as of the share price here from Friday. For the next 12 months, he earns a 7.8% return from the premium. And you get this from taking the $1,135, dividing that by his cost basis of $14,600. So Randy also received the next 4 dividend payouts from PepsiCo. This is not including the potential dividend increases. Should PepsiCo increase the dividend, it would actually be higher or more. So the current forward dividend yield for PepsiCo is 3.8%. So adding the 7.8% premium with the 3.8% dividend, Randy's total income return is 11.6%. This is just the income, has nothing to do with the share price. That's why regardless of the outcome 1 or outcome 2, Randy's getting this 11.6% income return. So with the first possible outcome where Randy keeps his shares in September 2026, remember because the share price of PepsiCo is below $150, his income return would be 11.6% or $1,690. So with the second possible outcome where Randy is obligated to sell his shares in September 2026 because the price of PepsiCo is above $150, his income return would be 11.6%. And because he sold the shares for a small gain from $146 to $150 a share, his total return would be 14.3% or $2,090. And you get this by adding the 11.6% income return with the 2.7% capital appreciation return. So the example that I just shared is all with real numbers based on Friday's share price of PepsiCo. Income investing can take many shapes and sizes. There is no one size fits all, and there are definitely pros and cons. So let's take a look at some of the pros and cons of this approach. So the pro is that you lock in that 11.6% annual return in terms of the income today. Regardless of what the share price does, you're locking in that 11.6% and you're focused on the income and you're locking that in today. Another pro is that it protects you against a bear market, or if you think that the market will be red in the next year, or if you want to hedge against the odds of a recession. Another pro is you can push out about 90% of the taxes for the next year, but generate the majority of the income today. So let's break that down. So of the $1,690 in income that you would generate, 92% of that would be paid in 2026. You would generate $550 in dividends. Of that, $416 would be generated in 2026. You would also generate the $1,135 in the premium, which would be captured today, but taxed in 2026. So you're not paying the taxes on that until April 2027. Now these numbers are just with 100 shares from the example with Randy and Chili. These numbers also scale up based on how many shares you have, but the percentages stay the same. Now let's take a look at some of the cons here. The first con is that you are obligating yourself, in the case of Randy here, to wait out the trade regardless of what the market is doing. So you can change your mind, but it may end up costing you to close out the trade earlier. So if the share price of PepsiCo hypothetically were to go up, your premium that you generated, the $1,135 with the example of Randy, that premium would go up if you wanted to buy it back and close out the trade. So it would actually be a negative in terms of the return that you would generate. So you can change your mind, but I would only do this if you're really set on the terms and conditions that you're setting, because you're the one making the trade. You have to be pretty happy with those terms. Otherwise, the trade can go against you if you end up changing your mind. But if the share price of PepsiCo goes down dramatically, you could close out the trade earlier and capture a good percentage of that premium, the $1,135. So it really just depends on what the market's doing, but it is definitely a hedge, but it can work against you if you want to close out the trade early and the share price of the stock goes up. Another downside or another con is the upside is capped in a bull market. The share price of PepsiCo may skyrocket above $150, thus resulting in a lower total return had you held the shares outright. So this is always the case with covered calls. You're trading the upside potential for the premium income. That's how it works with a covered call. So you want to make sure that you're understanding what you're doing here and that you're satisfied with the income and the return that you're generating here. And that's why I said at the beginning of the video that this is really focused on the income and not so much on the total return. But really the key word here is the potential total return. And then the last con here is that 67% of the income will be taxed at a higher rate and classified as ordinary income. When you break it down, the 11.6% is a breakup of qualified and non-qualified. 67% of the income that you would generate here is going to be classified as ordinary income. This would be great if it's held in a Roth IRA, for example, because then you're shielding yourself from the tax obligation here. But it's important to understand that these are not quite as tax efficient. Just like a lot of these other covered call ETFs, a lot of them are classified as ordinary income. So it's not, a qualified rate that you would get, where you would pay lower taxes. So that's very, very important to understand. So those are the pros and cons of making an 11.5% dividend yield with PepsiCo. There's some upside and there's some downside, but I think for someone who's looking for income, I think this can be an incredible way to boost your income in early retirement. I'll take the example with me. So I'm no longer working a 9-to-5 job. I'm relying on the income from my portfolio to pay for my living expenses. I reached what is called barista fire, right? And so I'm not working a 9-to-5 job, so I need to get a little bit more creative and squeeze a little bit more juice out of the orange from my portfolio. And this is one way that you can generate a little bit more income. Now, this is how you can do it yourself with an individual stock. You could do this as well with an ETF, but you may not get an 11.5% dividend yield if you want to do it conservatively. You may get a 5%, a 6%. This is a way that you can do it, in my opinion, relatively conservatively with a stock that most people are familiar with. But I mean, PepsiCo, if I'm thinking about doing this on an individual stock, this is more of a conservative stock that I would personally feel more comfortable doing this on because, PepsiCo, it holds hundreds of different brands. In itself, it's almost like an ETF. It's a basket of different brands at a single company. But if you're not comfortable doing it on a single stock, you could absolutely do this with an ETF. It's all about how can you generate a little bit more income. And you can do this yourself instead of paying high management fees for some of these covered call ETFs. And it's pretty fun to learn, right? And so I hope that this video was helpful. I hope that you learned something new. I'd be curious to hear your thoughts if this is something that you do, what stocks you do this on or ETFs, or if you just prefer to do it with covered call ETFs. But yeah, thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.